Your Excellency, thank you very much for this interview. Undoubtedly, the first question in light of the current security situation is your assessment of the implications of this war on the Saudi economy, as well as on the fund's strategy.
Naturally, the impact of the war is not limited to the Saudi economy or the fund's strategy alone, but extends to the global economy as a whole. Oil prices have increased, shipping and insurance costs increased, food prices have increased, as a significant portion of chemical fertilizers passes through Saudi Arabia and other Gulf countries. In addition, helium gas is facing difficulties reaching Taiwan, leading to delays in semiconductor chip manufacturing or increased costs. As for the fund, our strategy is long-term rather than short-term. It spans the next 5 years and represents a continuation and evolution of previous strategies since the fund's establishment in 1971, through the transformation phases in 2015 and 2017, followed by the 2021 to 2025 strategy, and now the current strategy for the period from 2026 to 2030.
We will return to the fund's new strategy or its next phase shortly. But specifically regarding the war, Your Excellency, were there any initial commitments to external deals that are now being reconsidered due to the impact of the war?
Some deals and investments are being reviewed, whether due to the war or for reasons related to economic feasibility. We continuously reassess our priorities and existing investments. I cannot say that we cancel a specific investment in favor of another, as this process is inherently dynamic, both in times of war and under normal circumstances. However, it is certain that the presence of war places greater pressure on the need to reposition certain priorities.
And where do the priorities lie?
Priorities are naturally defined based on national needs and aligned with the requirements of the national economy, which constitutes a key priority for us. We do not operate solely as financial investors. Rather, our role extends beyond that. Since the fund's establishment, the objective has not been limited to generating financial returns. While returns are an important part of the fund's goals, they are not the only objective.
Financial returns and developmental objectives for the fund. Based on that, how do you measure performance? And what KPIs do you rely on to assess what has been achieved for the Saudi economy?
KPIs are significant in light of what has been achieved. To answer this question, it is important to review the fund's stages of development since its establishment in 1971. In its early years, the fund focused on developing the local economy, particularly in the financial sector, the petrochemical sector, and infrastructure projects such as railways, playing a clear role in driving development. In 2015, a major transformation took place. Developmental goals were no longer the sole objective, but became part of a broader framework that also includes economic feasibility. Limiting objectives to development alone would mean overlooking the economic viability of projects. In 2015, following the transfer of the fund from the Ministry of Finance to the oversight of the Council of Economic and Development Affairs, work began on redefining its strategy for the 2018 to 2020 period as part of this transformation phase. During this transformation period, we established several companies and major projects. Among the largest globally were launched, including NEOM, the Red Sea Project, and Qiddiya. The fund also strengthened its partnerships locally and internationally, contributed to the creation of significant job opportunities, and enhanced collaboration with the private sector. At the start of 2021, the fund entered the third phase of its strategic development for the 2021 to 2025 period, marking a stage of expansion and growth while building on the achievements of previous phases. Several national companies were launched, including Roshen, Humine, and Savvy, while existing companies such as ACWA Power, Bari, and Ma'aden were further enabled and developed, with the fund playing a key role in expanding their operations and strengthening their impact. The current strategy, covering the period from 2026 to 2030, builds on this trajectory and focuses on transforming 13 strategic sectors into 6 integrated economic ecosystems.
On what basis were these ecosystems selected?
To answer this question logically, it is important to explain how the fund's investment structure has evolved. In the early phase of its strategy, the approach was based on a geographic allocation of investment objectives. The fund had 6 investment portfolios. 2 dedicated to international investments, 2 to domestic investments, and 2 to local real estate investments, including a dedicated portfolio for mega projects. We have now moved to implementing 3 main portfolios: the Vision Portfolio, the Strategic Investment Portfolio, and the Financial Investment Portfolio. Each of these portfolios has distinct investment objectives, although all are ultimately aimed at delivering strong financial returns. The Vision Portfolio focuses on enhancing integration across priority strategic sectors for the Saudi economy and the Public Investment Fund. It also aims to maximize value for the fund's companies and support local economic growth through the development of integrated economic ecosystems, numbering around 6. The second portfolio, which is the Strategic Investment Portfolio, focuses on managing and maximizing returns from strategic assets, while also increasing the economic impact of the fund's companies. The third portfolio, the Financial Investment Portfolio, is primarily focused on generating financial returns, both domestically and internationally.
Since the transformation, the fund has achieved average returns of around 7%. Are you now targeting higher returns than that?
Overall, yes. Let me provide a historical overview of the fund's achievements. The fund's AUM, or Assets Under Management, has grown from approximately 500 billion Saudi riyal in 2015 to more than 3 trillion riyal. Total shareholder returns have averaged around 7% annually. Approximately 750 billion Saudi riyals have been invested domestically, contributing an estimated 910 billion riyal to the GDP. Most importantly, local content has reached around 590 billion Saudi riyal. These indicators contribute to enhancing what is known as economic complexity, as the focus is not solely on GDP growth, but also on the diversification and sophistication of the economy, with local content being a key pillar of this concept. In addition, a number of global asset managers and investment funds have established regional headquarters within the kingdom. Also, from 2021 to 2025, foreign investments exceeding 75 billion riyals were brought into the Saudi market, with support from the fund.
Is foreign investor appetite today affected by the war?
Certainly, investor appetite is affected across the board, not just among foreign investors. Even European investors within Europe see shifts in sentiment, as do investors in Asia, whether in China, South Korea, Japan, or Indonesia. Everyone is impacted. That is because the war is not taking place in a remote region, but in one of the world's most critical areas for supplying essential commodities, including oil, gas, and their derivatives, as well as industrial fertilizers. As a result, it is only natural that the situation is having a clear impact.
Your Excellency, does the new strategy include any changes in the scale of investments to be deployed domestically compared to other investments?
In fact, this approach has been in place from the outset and is something we continue to build on. It has been reflected in the restructuring of investment portfolios into 3 main categories: the Vision Portfolio, the Strategic Investments Portfolio, and the Financial Investments Portfolio. Our primary focus remains on the Saudi economy by strengthening local investments in a way that delivers strong financial and commercial returns.
Is there a target ratio for the allocation of domestic investments?
From the outset, we announced that approximately 80% of investments would be domestic, compared to 20% allocated to international investments. Historically, the fund's focus on domestic investment was around 98.5%, before international investments increased to approximately 30%. However, this does not mean reducing the absolute value of investments. Amounts may continue to increase, even if the percentage declines, as assets under management is expected to grow in the coming years. Therefore, even with a lower percentage, the total value of investments can still rise.
Your Excellency, over the past 5 or 6 years, we have seen some significant exits from the local market, particularly in the stock market, most notably the full exit from Sabek, as well as a reduction in your stake in STC. Could we see similar exits going forward?
Certainly.
This year?
I can't say whether it's this or the next, but in general, our investments go through around 7 stages, starting with the initial investment concept, followed by preliminary and detailed feasibility studies, then execution of the deal or project, company establishment, performance monitoring, and finally the seventh and most important stage, the sale. These stages are structured this way because exit or sale is a fundamental part of the investment cycle. No investor holds a single investment indefinitely. For example, we saw that Sabic had reached a suitable stage for us to exit, and that its transition to Aramco would create greater synergies between the two. As a result, we recycled the proceeds from that exit into new investments. Similarly, in telecoms companies or others, we reduce our stakes and redirect those investments into new or existing companies, with the aim of expanding our investment scope and maximizing returns.
Your Excellency, even before the war, discussions in Saudi Arabia were centered around spending priorities, particularly with major upcoming events such as the World Cup and Expo. Where do spending priorities stand in the kingdom today?
As mentioned, spending priorities fall under the Vision portfolio, which consists of 6 main sectors. The first ecosystem is travel, tourism, and entertainment. The second is urban development and urbanization, including projects such as Roshan, New Maraba, and Kaft. The third is advanced industries and innovation, including companies such as Lefra and Sear. The fourth sector is logistics services, including companies such as Maiden, Hadid, and Bari. The fifth is infrastructure for renewable and clean energy, as well as water. The sixth infrastructure is NEOM. If we return to the first sector, that's travel, tourism, and entertainment, we find that it includes a number of companies that have been integrated under one framework. For example, King Salman International Airport. With major events such as Expo and the World Cup approaching, passenger numbers are expected to rise significantly. Therefore, we must invest more in developing and expanding King Salman Airport to accommodate this demand. Similarly, Riyadh Air aims to increase the number of routes and connect Riyadh to destinations around the world. Investment in Expo and the construction of World Cup stadiums are also key priorities within this sector. It is also important to note that priorities have evolved alongside the strategy. During the 2021 to 2025 period, artificial intelligence was not as prominent as it is today. As a result, some priorities have been reshuffled and investment objectives repositioned, with greater focus on AI infrastructure and investments in AI companies, both domestically, such as Humane, and internationally across regions including the United States, Europe, and Asia. Accordingly, the repositioning of investments remains an ongoing process, driven by emerging global priorities.
So, artificial intelligence is a priority today. Could defense also be a priority?
Defense is certainly one of our key priorities. It has been important in the past, but it carries even greater significance today. We have SAMI, a company specialized in defense industries. It falls under the third sector, which is advanced industries and innovation. This ecosystem also includes companies such as Humane, Tazaru, Sear, Sami, and Lefera in the healthcare sector.
Your Excellency, we have heard a lot about the reassessment of some major projects, or even the cancellation of some. Are these reports accurate?
This reinforces what we consistently emphasize. We continuously review our priorities. We rely on top-down approach and a bottom-up approach. The top-down approach is driven by the Public Investment Funds Board, where strategic directions and priorities are defined. The bottom-up approach, on the other hand, originates from the companies and projects themselves, with recommendations based on operational and investment realities. Accordingly, guidance is provided to our portfolio companies, and projects are reassessed in terms of their financing structure, whether they are fully funded through equity, through debt and loans, or by bringing in partners through joint ventures. As a result, there is always an ongoing review of how investments are directed. While the overall scale of a project may not necessarily decrease, but the level of capital investment from our side may be reduced.
For example, NEOM specifically, NEOM consists of several zones, and there has been a lot of talk about the cancellation of some projects within it.
So far, what is being circulated about the cancellation of projects in NEOM is not accurate. No projects have been canceled. However, the company has been directed to rearrange its priorities. There is a common perception that the line represents NEOM in its entirety, whereas in reality, it is just one of the projects under NEOM. Is it necessary for the line to be completed by 2030? I don't think so. It's good to have, but it's not a must-have. The must-have is the industrial zone Oxagon, which includes a port for commercial shipping and trade, multiple data centers, and hosts a number of local and foreign investors. Based on our strategy and the ecosystems we operate within, Oxagon is currently the most suitable focus for investment, while some other projects within NEOM may be deferred. As for deferrals, these are managed through directives given to our companies, including NEOM, within the framework of an integrated ecosystem under the Vision portfolio. The company itself evaluates these directives after receiving guidance from its board and the funds board, and we then await the company's plan on how to achieve all or part of the objectives in the most financially efficient way possible. Historically, most of the fund's projects, especially in mega projects, infrastructure, and real estate, were fully funded through equity from the fund. But is this the optimal approach? Certainly not. This aligns with our current strategy, which aims to achieve the same objectives or a significant portion of them with less capital. As an economic catalyst, we initially assumed the early-stage risks by developing the infrastructure. Once that phase is completed, it becomes much easier for the private sector, both locally and internationally, to step in and invest. For example, it would be extremely difficult for any private investor to initiate a project on the scale of NEOM or the Red Sea projects, given that their scope is comparable to entire countries, and in some cases even larger than certain European or Middle Eastern nations for a single company. Therefore, it is impossible for any private sector investor, whether local or international, to initiate. However, we initiated by putting infrastructure in place. And now, the Red Sea, most people, whether local or international, saw on the ground what offerings are in place, improved investor understanding, and consequently, increased interest. Today, we are seeing growing demand from both local and international investors to participate in these projects. I recently met with one of the largest American investment management firms, and they said, "We understand infrastructure, and we like it and want to invest in it." We have also observed that investors tend to invest in sectors they understand. As a concept, the Red Sea, or Roshan, are unprecedented in the entire world. As these projects evolve and become more concrete, investment decisions become much easier for them to make.
Your Excellency, let us move to the final topic in this interview, one that concerns a wide segment of viewers and has recently sparked debate: the sports sector. Specifically, the fund's investments in major football clubs, where questions have been raised about a lack of parity and fairness in spending among these clubs. How do you respond to that?
I don't think this is true. When comparing clubs within the kingdom to their counterparts in Europe, we see that systems such as financial fair play are implemented there. In Saudi Arabia, we aim to adopt similar frameworks once we reach a comparable level, in coordination with the relevant regulatory bodies, such as the Ministry of Sport and the Football Federation. In general, club revenues are derived from ticket sales, broadcasting rights, merchandise, and sponsorships. In Saudi Arabia, this is further supplemented by support from board members, as well as contributions from fans, which often come in the form of donations or financial backing. Naturally, clubs differ in the scale of these resources. Some receive greater support from their fan base or board members than others, which directly impacts their spending capacity. As for the fund, it invests in club companies at relatively similar levels. However, we cannot control donations or external contributions that fall outside its investment framework, whether from honorary members or fans.
However, the primary objective for these clubs remains their privatization and eventual sale. Are there serious negotiations underway in this regard?
Yes, there are ongoing negotiations, and we expect, God willing, to announce within the next 2 days the sale of our stake in one of the clubs.
Can we know the name of the club?
You will find out within the next 2 days, God willing.
And are there other deals that could be completed this year?
As mentioned earlier, our investments go through several stages, with the 7th being exit or divestment. We entered the club sector with the objective of improving governance, which was previously quite weak but has now significantly improved. We have also worked on enhancing financial sustainability and increasing club revenues, particularly on match days, where revenues have risen by approximately 120%, more than double. We are gradually moving toward the privatization of these clubs. While we may retain certain stakes, we will not remain the majority owner.
Your Excellency Governor Yasir Al-Rumayyan, thank you very much for this interview.
Thank you.